stocks are rising today after December's inflation print came in softer than expected in those PPI numbers. Now, this comes after early morning momentum following a Bloomberg report that President-elect Donald Trump's economic team is discussing a gradual approach to tariffs. Joining us now with more, we've got Megan Horneman. She's the Chief Investment Officer at Verdence Capital Advisors. Megan, great to speak with you. So two key catalysts for the market this morning, obviously the bigger of the two being that inflation data coming in softer than expected here. How long do you anticipate this relief rally lasting?
It could be till tomorrow when we get the CPI report. That's the bigger one that I think the investors should be concerned about. And the PPI report, it's 1 month. Again, it was good data. Some of the things that we've been watching, services, that was relatively flat. Food came down. So that was a good report. But again, CPI is the bigger report tomorrow that we're going to be focused on.
What do you think we'll see in that, Megan? And I guess how much further progress do you expect in the coming months?
We're a little concerned that we're on this kind of upward wave here in inflation. And typically, when you look back at historical times of inflation, you don't have this perfect spike up and then perfect landing down, and it stays there. You tend to see it move in waves. And what we're concerned about over the first half of the year is that this refuel of economic growth we've seen since the Fed started cutting interest rates, this can reignite inflation pressures. And that's our bigger concern for the first half of this year. So we think there's plenty of pressures to the upside.
How are you thinking about seasonality within the data? Because we've seen this film before in terms of Q1 data showing a little bit softer inflation, but a lot of strength in the labor market. How does that frame your thinking of the inflation print that we're going to be getting this week?
So I think that's why you have to look beyond some of these just headline, whether it's CPI, PCE, the producer price index, to try and get a better picture of what inflation really is. So some of the things that we look at is when you look at the prices paid within the ISM services report that jumped significantly in the last month, prices paid in the ISM manufacturing. These are things that tend to lead to the higher inflation print. So we try and take out the noise of seasonality and look at some of the underlying things that can fuel that inflation going forward.
Megan, when it comes to what has been priced into the market, what hasn't been priced into the market, is the market still a bit too optimistic when it comes to the expected progress on inflation, when it comes to maybe what we are going to get from Trump policies and tariffs?
I think it is a bit too optimistic, specifically that U.S. large cap growth and technology side of the market. We've seen it's still very interest rate sensitive, and that's been really illustrated through the weakness we've been having over the past few weeks with the move higher in interest rates. So we don't think it's pricing in these upside risks to inflation for this year. And we also don't think it's pricing in the fact that the Fed probably will not have the flexibility the market expects. We don't think they'll do anything in January, obviously. And I think that the future months is really up in the air. We lean more towards the fact that they may have to stay on hold this year. They don't want to go through this, stop and go monetary policy that was very unsuccessful in the 70s and 80s.
Since you mentioned large caps, I want to go to a specific call you have on the tech sector, and that's in semiconductors. How defensive do you see that sector being in a volatile backdrop?
I think it's all of the areas there within the technology. These are all, I think, overpriced. So I think that's still sensitive to any moves in the broader sector. We aren't using that as a defensive mechanism right now. There is, when you look at outside of growth, you can look at value, but all of the large cap space is trading at a premium to its historical average.
How big of a risk is that?
I think we've seen it. This is a risk for volatility. We saw a 50% spike in volatility last year. I think we have to be prepared for another year where there'll be some of these big pullbacks. There'll be opportunities for long-term investors. I do believe that. Over the long term, we still favor equities over bonds. But right now, there's just a lot of volatility, a lot of uncertainty going into this year.
So given that backdrop, I know you mentioned you still favor equities over bonds, but what does positioning look like in that case? Does it make the 60-40 portfolio look a little bit more attractive?
So I think what you have to look at from the equity side of things is going outside of the U.S. The U.S. has been really the global leader. Valuations are very stretched, and it's not pricing in any of the downside risks. And we're seeing that with these elevated multiples, really across all market caps and styles. But when you look outside of the U.S., think about the developed international markets. I'm not saying that their economic fundamentals are so much better, but I'm saying their valuations are pricing in the downside risks that are presented with those economies.